When it comes to investing in the stock market, you have multiple different investment options to choose from. One of those investment options are called ETFs, or exchange traded funds. They're a type of fund, and funds in general are basically like a basket of multiple different types of investments all bundled up and put together for you into one single investment. So you could invest in an ETF that has thousands of different investments like stocks, bonds, or both inside of it, but you just have to purchase the one ETF. It's more simple, less time consuming, and typically more cost effective too. The thing is, there's literally thousands of different ETFs for you to choose from. Seriously, there are so many options out there. But there are different categories of ETFs that we can look at to help narrow things down. First, at the very top, there's both active and passive ETFs. Active ETFs are where a person or a group of people are responsible for deciding what investments should go into the fund. They individually select different stocks or other types of investments, and then also individually choose what percentage of those stocks or other investments make up the overall fund. They're essentially trying to make an educated guess on what will perform well or grow the most in value. But spoiler alert, it doesn't always work. Now, passive ETFs are ones where no one actually decides what goes into the fund. Instead, the ETF tracks a market index that already exists. A market index is basically a specific part of the overall stock market. It's all about dividing up and looking at different parts of the stock market. So for example, there's the total US stock market. That's the part of the stock market that only looks at US companies. There's also the S&P 500. That's the part of the stock market that only looks at the 500 largest companies in the US. And then there's also the total Canadian stock market, which is the part of the stock market that only looks at companies based in Canada. So passive ETFs are made up of the exact same investment options that are already included in a market index that already exists. It's all about matching the market as it is so that you can get, give or take, the same return. Now, within the category of passive ETFs, there's still many different options out there. For example, on top of passive ETFs being diversified by the types of investments held inside of them, like stocks or bonds, they can also be diversified by company size, by industry, and by geography, so the countries where the companies are based. Now, in this video, we're going to focus on that last option, and more specifically, we're going to talk about global diversification and why we personally invest in globally diversified ETFs.
Okay, so let's start by really clarifying what we mean when we say globally diversified ETFs. So let's say that you wanted a diversified investment portfolio. That's why you're going with the fund in the first place. But remember, there are multiple different ways to diversify. You can diversify by types of investments, so stocks or bonds, by company sizes, so small, medium, or large companies, by industry, so technology, banking, or any other industry, and or by geography, so Canada, the US, and global. When we talk about geographic diversification specifically, that would mean that instead of investing in an ETF that only includes companies from one country, so for example, only companies in the US, you would invest in an ETF that includes multiple different countries. So for example, the US, Canada, and other countries from around the world. Now, this is an interesting topic because typically when we, as investors in general, think about investing, we tend to think about the US first. And that makes sense because the US is the largest market in the entire world. You can actually see here that the US market is the largest market by a lot. This specific index shows them taking up about 65% of the global stock market. And the next largest individual country only takes up about 5% of the global stock market. So you can see that there's a big difference there. So because of this, and because of the information that we tend to see online, many people feel like they could and should invest in just the US. Personally, we feel like we hear people saying things like the US market is the best market for investors, or that the US market has had some of the best results over the past few years or even decades all the time. And this is true, especially if we look at the most few recent decades or shorter periods in time in general. But in addition to focusing on passive investing, if you're also a long-term investor specifically, meaning that you're looking to have your money invested for many years and potentially even multiple decades, then we're not trying to beat the market over the short term. We're looking for a long-term growth, which means that we should be looking further back historically. So let's do that. If we take a look at the numbers over the past 50 years with this chart, we can see that there's actually been many global markets that have actually performed well and better than other ones, depending on which decade that you look at. And if you look at the last column of this chart, you can see that an equal weight or an equally weighted portfolio actually outperformed the US over this period of time. Our takeaway from this historical data and information is that we simply don't know and can't accurately predict which market is going to do well in any given short period of time. So one of the best ways to reduce your overall risk and avoid missing out on some of the best returns statistically is to spread your money across different geographic markets. In general, the more diversified the fund is, the more you're reducing your risk. The less diversified the fund is, the more you're increasing your risk.
Okay, so now I want to back up a second and talk more about the term equal weight or equally weighted that we just mentioned. To refresh your memory, we were looking at this chart right here, and specifically the entire period column, where we saw that an equally weighted portfolio actually outperformed the US, which still performed very well, by the way. So what does equal weight mean? Well, it means that an investment portfolio that had an equal weight across geographies, so the same amount of US investments, Canadian investments, and other global investments, performed better than investing in a single geography. Now, to build on that, one strategy that's used in order to diversify an investment portfolio geographically is to use what's called a globally weighted index. What that means is that if we take all of the global markets in the world and compare them against each other based specifically on their market capitalization, so their size relative to each other, then we can figure out how big of an impact they each have in the overall global stock market. So you can think about it like this. How big is the Canadian market in comparison to other markets around the world? Or how big is the US market in comparison to other markets around the world? Now, the main reason that people would look at a globally weighted index specifically is because the perfect global combination or global diversification doesn't exist. Like we said earlier, no one knows for sure what market will do the best in any given short-term period of time. But we can get a good sense of how impactful each market is in comparison with other markets around the world, and then base our investment portfolio on that as a starting point. So to sum that up, a globally weighted index looks at every global market around the world and then compares them against each other based on their size, so their market capitalization. Now, there's actually multiple different indexes, and the correct term is actually indices, that all use slightly different criteria to show a globally weighted index. The reason that there's different ones is because different companies come up with their own specific set of criteria to determine the specific percentages. Now, one of them we actually showed you already earlier in the video, and it's called the MSCI All Country World Index. Then there's also the FTSE Global All Cap Index. Now we're gonna have both of them on screen so that you can see that the two of them are similar, but they also have some slight differences. In general, in both indices, you can see that the United States is the largest market in the world by far, so it takes up the largest piece of the pie in both charts. If we look at the FTSE Global All Cap Index specifically, you can see that the US takes up 63.13% of the chart, Japan takes up 5.75%, Canada takes up 2.87%, and then another 38 countries take up the other 28.25%. So what does this mean to us? It means that according to this globally weighted index, if you wanted to geographically diversify your investment portfolio, then this is what it could look like, or potentially what you'd want it to look like.
Okay, so now that we've seen what a globally weighted index looks like, how do you actually invest in one, or in a way that's according to one? So when we're talking about these globally weighted indices, like the ones from MSCI and FTSE, these aren't the actual investment products that you can invest in. Those are just the indexes themselves. Remember how we talked about how when we talk about investing in passive ETFs, those are ETFs that already track a market index that already exists. So you can find an ETF that tracks a globally weighted index, like one of these ones, if you want your portfolio to be diversified in this way. For example, one of the most straightforward ETFs that we can use as an example here is the Vanguard Total World Stock ETF with the ticker symbol VT. It tracks the performance of the FTSE Global All Cap Index, which is a globally weighted index. So the holdings inside of VT, so the country percentage breakdown, should be pretty close to matching the FTSE Global All Cap Index. That means that if you only invested in VT, then you would have a globally diversified investment portfolio that's globally diversified according to a globally weighted index. Now, like so many other things in life, it's not always as simple as this, because every investment product, and yes, an ETF is an investment product, has a variety of different things that you need to look at before you just go ahead and you purchase it. So if we take a look at VT, for example, one of the first things that you want to look at is the fee for the ETF, which is typically known as the expense ratio. Typically, from our personal experience and opinion, anything under 0.25% is a regular or good fee amount for a passive ETF expense ratio, or MER, as of right now. So from a fee perspective, VT has no concerns. Now, on top of the fee for the ETF, you also need to see where the ETF is available to purchase. And by where, I don't mean physically where, I mean what stock exchange is it listed on. VT specifically is an ETF that's listed on various US-based stock exchanges, which means that it's listed in or available to purchase in USD. What that means is that if you're in the United States, then you could go ahead and invest in VT if you wanted to. It has a low fee, it's it's globally diversified according to a globally weighted index, and it's available in your currency. But if you're in Canada like we are, then it's a little bit more complicated than that. If you're in Canada and your money is in CAD and not USD, then you'd need to convert your Canadian dollars into US dollars in order to invest in VT. And that involves either paying currency conversion fees or taking the time to use a currency conversion method like Norbert's Gambit in order to legally convert your money without having to pay a lot in fees. Either way, if you're in Canada, then it costs you either time or money in order to invest in US listed ETFs, which might not always be worth it. But there are other globally diversified ETF options available.
So like Dennis just said, there isn't an ETF exactly like VT available in Canadian dollars, but there are a few other globally diversified investment options that kind of come close to it, just with a few differences per each option. Now keep in mind that all of the ETFs that we're about to mention, they're all Canadian listed. So what that means is that you wouldn't have to convert your currency if you're in Canada. First, there's XWD, which is the iShares MSCI World Index ETF. You can probably tell from the title that it tracks the performance of the MSCI World Index, which is another one of the globally weighted indexes or indices that we mentioned earlier. Now that sounds great, right? It's basically like the Canadian version of VT, just offered by a different company, so it's iShares instead of Vanguard, and it also tracks a different globally weighted index, so the MSCI one instead of the FTSE one. But the catch here is that XWD has an MER of 0.48%, which is much higher than some of the other ETF options that are out there and available. Now, from our understanding, the reason for this is simply because when XWD was created, and it's been around for a long time now, since 2009 specifically, there was a lack of competition at that time. So iShares was able to charge such a high amount for it, and that seems to be the main reason that it's still remaining at that fee today. And in fact, it actually used to be even higher of a fee way back then. So that makes sense, but it maybe isn't the best option if you're just getting started now, since it has such a high fee. Now, the other two ETF options that are available in Canadian dollars that are the next closest to these globally weighted index ETFs are VXC and XAW. VXC tracks the FTSE Global All Cap Index just like VT does, except it excludes Canada altogether. So that means that no Canadian stocks are held inside of this ETF. Now, if you wanted to invest in this ETF but also include Canadian stocks, then you could potentially add an ETF like VCN, which just includes Canadian market stocks. But otherwise, VXC is globally diversified and it has a fee of 0.22%. Now, XAW actually tracks a different globally diversified index. It's the MSCI All Cap World Index, and it also excludes Canada altogether. So no Canadian stocks are held inside of this ETF. But again, XAW is still globally diversified, and it also has a fee of 0.22%. Now, the other globally diversified ETF options that we know about that exist in Canadian dollars and that actually include Canada inside of them are the asset allocation ETFs. Now, that's an entirely other topic for a different video, but from a high level, asset allocation ETFs, which are also known as all-in-one ETFs, are ETFs that are made up of multiple different ETFs inside of it. And the goal is to give you diversification in a simplified way. So instead of you choosing multiple different ETFs to give you diversification and balance, you just pick one fund that does all of that for you, hence the all-in-one part. So there are ETFs like XEQT, VEQT, and ZEQT that offer global diversification with a reasonable fee that still include Canada too. But one thing to note is that these asset allocation ETFs don't follow a globally weighted index. So they are still globally diversified, but the percentage allocation per country in that breakdown is different. So for example, VEQT has 30% of the ETF allocated towards the Canadian market, and then XEQT has 25% of the ETF allocated towards the Canadian market. So you can see from these examples, XWD, VXC, XAW, and then XEQT, VEQT, and ZEQT, that there isn't just one ETF that gives you the perfect global diversification. But we do have multiple different options to choose from that can give you global diversification inside of your investment portfolio.
All right, so we hope that you guys found this to be a helpful introduction into the topic of global diversification, and ideally now you know why we specifically invest in global ETFs. Keep in mind that there's a lot more to cover on this topic, so you can always ask your questions down below, but you can also join, and I highly recommend that you join, our course, Simple Investing for Canadians. This is where we really dive deep into this topic and also dive deep into what is the best ETF option for you specifically. And with that, we'll see you next week with another video.